All right, for those of you that are watching this video and actually clicked on the thumbnail because you were intrigued by that title, now I have an idea what you're thinking of what this video might be about Warren Buffett, a specific topic, but I'm here to tell you it's something completely different. And before I tell you what the subject matter is of the video here, let me just tell you a quick story about Warren Buffett. Now, we all know that Warren Buffett's one of the greatest investors of all time, if not the best investor of all time. He's got a current net worth of like $120 billion right now. One of the richest men in the world, within the top 5, maybe even the top 3. So this little story, exactly 30 years ago in 1993, Warren Buffett was interested in buying shares of Coca-Cola. Now, at the time, shares of Coca-Cola were trading for around $39 a share. And Warren Buffett was adamant that he was not going to pay more than $35 per share for Coca-Cola. He wanted to buy the stock, but he wasn't willing to pay more than $35 a share. And at the time, it was trading for $39. Now, what he could have done is what a lot of people do when they want to buy a stock at a cheaper price. They could just put in a limit order. It's called a limit order. He could have put in a limit order and told his broker, hey, if Coca-Cola falls to $35 a share, buy me the shares. Okay. Now, what he wanted to do was he wanted to buy millions and millions of shares of Coca-Cola. So he wasn't willing to pay the current price. He wanted to pay the price where he thought it was of value at $35 a share. Now, instead of putting in just a limit order and hoping and praying that Coca-Cola would fall from 39 down to 35, he made a specific options trade that netted him $7.5 million. Now, he wanted to buy shares of Coca-Cola, but he was paid $7.5 million just because he wanted to buy shares of stock. Now, in this specific type of trade, which is available to everybody, even you, even me, you can get paid as well because you're willing to buy a certain stock. Now, what happened was for this trade for Warren Buffett, eventually the shares of Coca-Cola never fell down to $35 a share. It actually went up above 39 from where it was. So what happened to Warren Buffett in this case? Well, he didn't get to buy shares of Coca-Cola at 35, but you know what he did? He got to walk away with the $7.5 million that he was paid because he put in an obligation to buy shares of stock. Now, to reveal what this video is all about, and I'm sure some of you might know by now based on the story, what we're going to be talking about today is the big reveal. Selling put options, okay? That's what it's all about. Warren Buffett is a huge seller of put options, and it's something he does for his Berkshire Hathaway fund that he runs and that he's been running for decades and decades and has made millions upon millions of dollars by selling put options. Now, this video is going to be relatively short, based on the other videos I've made. We're going to be talking about selling put options. Now, getting back to the Warren Buffett example, what Warren Buffett did in that case was he sold 50,000 option contracts, put option contracts at a strike price of $35 per share. Well, now, what did that do for him? Well, it obligated him to buy 175 million shares of Coca-Cola at $35. I'm sorry. It obligated him to buy, he sold 50,000 contracts. He sold 50,000 contracts, which would obligate him to buy 5 million shares of Coca-Cola at $35 a share, which would have been an overall investment of $175 million, okay? But so instead of him just outright, trying to buy shares of Coke for $35 and put in the limit order, he sold the 50,000 put option contracts, and there's 100 shares for each put option contract. So that obligates him to buy 5 million shares. And by selling those put options, he was paid $7.5 million. Every option contract has a price. And if you're the seller of those options, not the buyer, you sell those options, you're going to get money into your account. And why does someone pay you when you sell those put options to them? Because you're offering them basically a service or an insurance policy on their own shares. So what you're doing is you're obligating yourself to buy shares of a stock that you want to buy at a price that you want to buy it for. So Warren Buffett obligated himself to buy 5 million shares of Coca-Cola at $35 a share. And by, putting in his offer to buy those shares, he was paid $7.5 million by all the people that were buying those put options. Warren Buffett sold those put options. So you, as an investor, can do the same thing. Now, what we're going to talk about today is right here, the Smart Option Seller Guide to Selling Put Options, which is pretty much like what Warren Buffett does. If you find a stock that you like, you can sell a put option, collect the cash, and wait for the stock to, maybe come down to the stock price. Now, what I want to show you is here for a second, not here, I'll show you that later, is if anyone has heard of Bard, you can do a Google search on any topic, but Bard is Google's basically AI's version of their search engine. Now, I don't know if you know about this, but you go to bard.google.com right here. You go to bard.google.com. It's free. Now, what you can do is, this is the AI version. Now, what I'm going to do is I'm going to type in, you can type in any subject that you're interested in, and it'll come up with an answer. So if you're unsure, if you don't believe the story that I just told you about Warren Buffett, which is common knowledge, it's out there in the public, you can just do a regular Google search on, Warren Buffett selling put options, and you'll hear the story about 1993 when he wanted to buy shares of Coca-Cola. But you can type in something like this in this search bar down here. Does Warren Buffett sell put options? And you hit enter, and it's going to come up with this, like what AI does, artificial intelligence. It's going to come up with an answer, and it's going to tell you all about what he does. So I'll just read a little bit here to you. Yes, Warren Buffett is a known advocate for selling put options as part of his investment strategy. He has employed this technique for years, particularly to generate income while waiting for undervalued assets to reach his desired price point. And here's what we know about Buffett's use of put options. And it goes down, gives you some of the benefits of put options: income generation, lowering cost basis, portfolio protection. And right here, here's the story. In 1993, Buffett used put options to pocket nearly $7.5 million while waiting for the price of Coca-Cola shares to drop. And he's also known to sell put options on indices such as the S&P 500, expressing his long-term bullish outlook on the market. Okay, so Buffett typically sells naked put options, meaning he doesn't own the underlying assets and has to buy the shares if the option is exercised. This requires a high level of risk tolerance and capital availability. So there you go. Warren Buffett sells put options, and here's some other resources right here. So if you want to learn more about it, you can go to bard.google.com or just do a regular Google search. So let's go back to our what I call my cheat sheet here. So what we're talking about today is selling put options and how you do it, and why would you want to do it, and how to get your hands on shares of stock. Now, we all know that the stock market has been the greatest wealth generator for any average investor over the long run. You have to hold for the long run. You hold good stocks and they go up over time. So if you want to be like Warren Buffett and make, some money, now none of us can play in the same level as Warren Buffett, but you can use the same strategy. All right. So just thinking back to what Warren Buffett did, he wanted to buy shares of Coca-Cola because it was a company that he wanted. He researched, he did the fundamental analysis on, he looked at the stock charts. He knows that it was worth $35 and he didn't want to pay more than that. So what you yourself can do is that if there is a stock that you like and you're interested in buying the shares, and you don't want to wait for the stock price to fall because you don't know if that stock price is going to fall, you can sell a put option. So here's the 5-step technique, the Smart Option Seller Guide to Selling Put Options. Number 1, choose a stock that you're interested in buying. Doesn't matter what it is. As long as you've done your research and you know it's a good company, you say, okay, I want to buy shares of this stock, but I'm not going to buy the shares at its current price. Number 2, as far as the options are concerned, you choose a price level, which is also what's called the strike price of the option. And that determines, what price you're interested in buying that stock for. For Warren Buffett, Coke was at 39. He wanted to buy it for 35. So for you, for numbers 1 and 2, you pick your stock and then you choose the level in which you want to buy or potentially buy shares of that stock in the future. All right. Number 3, you check the expiration dates because all options have different expiration dates. And we're going to look through a quick example. And you have to decide which expiration date you want to use. You want to use a close to expiration date, a farther to expiration date. It's up to you. You go manually through and you see how much that specific strike price is paying out. Now, step number 4, once the strike price and expiration dates are chosen, you just sell that specific put option. And number 5, and you collect the cash, all right? You sell something, someone's going to pay you, so you collect the money. And number 5, you just wait until expiration date to come around to see if you get to buy the shares of the stock. Now, I'll let you know is that in order to eventually or actually buy the shares of the stock price has to come down to your level and stay there through expiration in order for you to actually follow through and buy the shares of stock. In Warren Buffett's case, Coca-Cola never fell down to 35, so he didn't get to buy the shares. But he was compensated for his time, and he was paid $7.5 million. All right, so let's look through a quick example here. And we're going to stick with Coca-Cola because, that's what we've been talking about. That's what Warren Buffett did. So here's a current chart of Coca-Cola. Okay. Currently $58.61. That's where it closed on Friday, December 8th, 2023. Now, if you wanted to buy shares of Coca-Cola, but you don't want to pay its current price of $58, you have to decide, where would I be comfortable, or where do I want to buy shares of Coca-Cola? Now, in this case, let's just use the last swing low of $52, or somewhere around $52, because Coca-Cola, we all know, is a very stable company, great dividend paying stock. You want to get your hands on some shares, but you want to pay a cheaper price. So $52 or somewhere around $52 would be a price where you would be fine buying at least 100 shares of Coca-Cola. Each option contract consists of 100 shares. So if you do this trade, you have to be committed to buying at least 100 shares at the strike price. Let's just say it's $52. 52 times 100 is $5,200. So eventually you may have to come up with $5,200 to buy your 100 shares. So if you're good with that, let's check the option chains and see how much Coca-Cola options are paying. Now, this is the option chain for Interactive Brokers. It's a well-known broker. I use them. If you want to get information on Interactive Brokers, down in the description below the video is a link for Interactive Brokers. You can click on it if you wish. So we're pulling up, this is an option chain, and we're pulling up options for Coca-Cola. We've got our put options on the right here. So, and along the top, we have all the different expiration dates that you can choose from. So let's start out with the next expiration of January 19th, 2024, because we need a little time here. And you're interested in potentially buying shares of Coca-Cola in the low 50s. Now, here are the strike prices that you can look at. You have to choose one of these strike prices. You just can't randomly pick a price where you want to buy Coca-Cola. You have to choose one of these strike prices. And these are all the same for every broker out there. No one could choose different. No one gets to choose different. These are all the same for no matter what your broker is or who your broker is. So in this case, 52.5 strike. Here's the price, the bid and ask price is where you want to look. So these are only worth about 7 cents, and you have to multiply these numbers by 100 to get the actual dollar value. So if you sold these 52.5 puts, you would get $7. Not a lot of money in those. Coca-Cola is a very stable stock, so the option prices are going to be a bit cheaper than, let's say, a more volatile stock. So let's go out a little bit further in time. Let's go out to February. Let's see what those things are trading for. 52.5 puts are worth roughly, let's get rid of this here. Sorry, my Norton, got to keep the computer protected. The 52.5 puts are trading roughly about 14 cents or $14 for each contract you sell. So, once again, they're not a lot. So let's go out to May here. The May 52.5 puts would be worth roughly, okay, so 52 or 53 cents. You always want to trade something right in the middle. So if you were going to sell these put options, you can receive $52 for every 100 shares you're willing to buy. Okay, so someone's going to pay you $52 right up front for every 100 shares of Coca-Cola that you're obligating yourself to buy for $52.5. Remember, Coca-Cola is at $58.50, so you're getting yourself basically a $6 discount. You're trying to get yourself a $6 discount to buy your 100 shares. And on day one, which is, let's just say December 8th, 2023, you sold these things for 52 cents or $52 each, you would get right in your account. Now, all you'd have to do is wait until May 17th, 2024 to come around, and you have to see where Coca-Cola is trading at that time. And if Coca-Cola is trading at $52.50 or below, you will be called upon to fulfill your obligation and buy the 100 shares, and you'll have to come up with $5,250 to pay for the shares. Now, if you wanted to do the 50 strike, you can get roughly $29 for those, and now you're obligated to buy 100 shares at $50 a share. Now, you can go as far out in expiration as you want. You can go all the way to January 2026. We'll see what those things are worth. The more time that you give, the more money you will get. It's just that you have to wait longer to see, where the final, where Coca-Cola will finally fall on that day. So the longer the amount of time you give, the more money you get, because it just gives Coca-Cola more time to potentially move around. So these things will be worth roughly, well, this is pretty wide. I'd say if we looked at the 50s, $2.10 per contract, which is $210 you'll get for every one contract that you sell. So if you want to go all the way out to January 26, you'll get $210 in your pocket. Now you have to wait until January 2026 to see if it comes to fruition. And the one thing I will say is that option contracts can be bought and sold at any time you want. So if you sell these January 26 put options today, you don't have to wait all the way until January 26 to get out of the trade. If you want to get out of the trade, meaning you will buy that put option back, you can buy it back at any time for whatever its current value is at that time. So you sell it today, you can buy it back next week, and maybe you make yourself, you'll have to pay the going rate. So if you sold it at, let's say, $210 today, and let's say a couple weeks from now it's worth $2 per contract, well, you sold it at $2, you buy it back at $2, you've made yourself 10-cent gain or $10 gain. So you don't have to wait until expiration. You can get in and out at will. But, if you're really going to do like what Warren Buffett does, you sell the put option and you wait until expiration. Okay, so if you want to, let's just look at January 2025. So a little over a year from now, these 50 puts and 52.5 puts are worth, let's see, the 52.5s are worth, $1.50 something, so that'd be $150. And the 50 puts are worth, let's say, $1.10, so $110. So you decide, you go through the expiration dates and you see how much these things are worth. You sell it, which means now you're on the hook to potentially buy 100 shares. So make sure, let's go back to our cheat sheet here. Make sure it's a stock that you're interested in buying. Make sure it's a quality company, and sell the put option and wait and see what happens. That's it in a nutshell. That's how you do it. That's how Warren Buffett did it in the example, and that's how he does it. Okay, and that's how you can do it. So there's your example about selling put options. Now, let's quickly go to our website, smartoptionseller.com. This is our website. If you want to learn a little bit more about us, here's our services header right here. We have a couple newsletters that we sell. We do the same thing as Warren Buffett. We sell put options on quality stocks. This is our Smart Option Seller newsletter. This is our bread and butter. We also have our vertical spread trader newsletter. Norton really wants to protect me today. So you can go to our services tab. We have our newsletters. We have our one-on-one coaching. If you need a little help before you actually want to start selling put options, you can get some help with our coaching. You can also go download, or I should say, get our free ebook, Put Selling Basics. Let me just run through this real quick. Put Selling Basics is our free ebook. It talks all about selling put options, what they are, why we love it so much, why it's such a great trade. Scroll down, put your name and email address in here. We'll send you an email back with a link to download the ebook. Also, another thing about Warren Buffett, selling put options is not the only thing that he does. If you want to look at another options trading strategy, go to our special reports here. The Secret to Buying Warren Buffett for Pennies on the Dollars, another option strategy that I wrote about, so you may be interested in that. Okay, so that's it. That's in a nutshell how you sell put options. Okay, even Warren Buffett at 93 years of age selling put options. You can't go wrong with that. In the description below the video are a couple links to other things that I use, websites, other services, books that I recommend. So have a look down there. give me a thumbs up, leave me a comment. Don't forget to like this video. Don't forget to subscribe. Send me an email. I will always answer emails. I hope this video has been helpful. I do these videos for free to help out the trading community, and hope everyone has a great weekend. All right, this is Lee Lowell signing off.